Self-storage is one of the most boring real estate businesses in the market, and that is exactly why investors like it. People move, people downsize, people renovate, people get divorced, people start small businesses, people inherit things, and at some point, many people simply run out of space. That is where extra space storage, ticker EXR, becomes interesting. EXR is one of the largest self-storage REITs in the United States, but the question in 2026 is not just whether self-storage is useful. The real question is whether self-storage is still a good investment, because after the post-pandemic boom, the easy growth story is not as simple anymore. So in this video, we're going to break down how extra space storage makes money, what the recent numbers show, what risks still matter, and whether EXR deserves a place on an investor's watch list. Self-storage is boring real estate, but boring real estate still has to grow cash flow. Extra space storage is a self-storage REIT. In simple terms, the company rents storage space to people and businesses that need extra room. That can include personal storage, moving storage, business storage, boat storage, RV storage, and other storage needs. But EXR is not just a small storage operator. At the end of the first quarter of 2026, the company owned and/or operated more than 4,300 stores. It had about 3.0 million units, and it had more than 335 million rentable square feet. That scale matters because self-storage is still a fragmented industry. A large operator can benefit from brand recognition, technology, revenue management, third-party management, acquisitions, and operating efficiency. For beginners, the easiest way to think about EXR is this. EXR rents space to people who have too much stuff and not enough room. But to understand whether that is a good investment, we need to understand why self-storage works as a business. Self-storage works because demand is often driven by life events. A person moves, a family downsizes, a home gets renovated, a couple separates, a small business needs inventory space, someone inherits furniture, or a household simply has less space than it needs. That demand is very simple, and simple demand can be valuable. Self-storage also has some attractive business features. Leases are often short. Pricing can adjust faster than in some other real estate sectors. The monthly ticket can be smaller than residential rent, and operations are usually less complicated than running apartments, malls, or office buildings. But investors should not confuse simple with guaranteed. Self-storage is resilient, but it is not immune. If people move less, buy fewer homes, or become more price-sensitive, demand can soften. Self-storage demand is simple, but simple demand does not mean guaranteed growth, and that is why the business model matters. Extra space storage makes money in a few different ways. The core business is rental income from storage units. The company also generates income from tenant reinsurance, management fees, acquisitions, joint ventures, and bridge lending. But for most investors, the key operating drivers are occupancy and pricing. If EXR keeps facilities highly occupied and can raise rates over time, revenue can grow. If expenses stay controlled, that revenue can turn into NOI. And if NOI supports the overall business, investors eventually watch core FFO and dividends. That is the REIT math. Storage units create revenue. Occupancy and pricing drive the engine. NOI shows property-level performance, and core FFO helps investors understand recurring cash flow available to the business. So the storage unit is the product. Occupancy and pricing are the engine. But in 2026, that engine is operating in a very different environment than it did during the boom. Self-storage had a very strong period after the pandemic. There was more moving activity, more home changes, more life disruption, and more demand for flexible storage space. But that boom did not last forever. As the market normalized, self-storage growth became harder. Home sales slowed. Mobility became weaker. New customer rates faced pressure. And investors started paying more attention to occupancy, move-ins, move-outs, and pricing power. This does not mean self-storage is broken. It means the easy boom is over. Now execution matters again. A strong operator can still perform well, but the sector no longer gets a free pass just because demand was strong a few years ago. So the question becomes very practical. Are extra space storage's current numbers showing improvement? Let's look at the first quarter of 2026. In the first quarter of 2026, Extra Space Storage showed signs of improvement. Same-store revenue increased 1.7%. Same-store NOI increased 1.2%. Same-store occupancy was 93%. And core FFO per share was $2.04, up 2% from the prior year. Those are not explosive numbers, but they are positive. They show that EXR is not collapsing. The company is still operating at high occupancy. It is still generating strong core FFO, and it is showing some improvement after a more difficult period for the self-storage sector. But investors should keep expectations realistic. This is not a hyper-growth story. It is a real estate cash flow story. EXR is improving, but this is not a hyper-growth story. That becomes even clearer when we look at the full-year guidance. Extra Space Storage's 2026 guidance shows stability but not explosive growth. The company expects core FFO per share between $8.05 and $8.35. Same-store revenue growth is expected to range from negative 0.5% to positive 1.5%. Same-store expense growth is expected to range from 2% to 3.5%, and same-store NOI growth is expected to range from negative 2.25% to positive 1.25%. That is an important mix. Core FFO may remain solid, but revenue growth is limited. Expenses may grow faster than revenue, and same-store NOI could still be slightly negative depending on where results land. So guidance shows stability, not a growth explosion, and that is why investors need to look past the headline and ask what could limit future growth. The first issue is occupancy and pricing. Extra Space Storage reported same-store occupancy of 93%. That is strong. High occupancy is usually a good sign because it means the company is filling its properties. But high occupancy alone is not enough. Investors still need to ask whether prices can rise. Are new customer rates improving? Are existing customers accepting rent increases? Are move-ins strong? Are move-outs under control? How much churn is there? These questions matter because occupancy without pricing power can limit growth. A storage facility can be mostly full, but if the company cannot raise rents enough to offset expenses, NOI growth may stay weak. So high occupancy is good, but pricing power turns occupancy into growth, and that leads to the second major risk: expenses. Self-storage looks simple from the outside. A building, a gate, some units, monthly rent. But the business still has real expenses: property taxes, insurance, repairs and maintenance, payroll, marketing, utilities. In the first quarter of 2026, same-store expenses increased 2.7%. Insurance expense increased 12.3%, and repairs and maintenance increased 7.9%. That matters because NOI depends on the spread between revenue growth and expense growth. If revenue grows slowly but expenses rise faster, margins can come under pressure. This is why investors should not analyze self-storage only by looking at occupancy. A simple building can still have rising expenses. And beyond property expenses, there is another factor every REIT investor has to watch: interest rates. Self-storage may be simple, but REIT math still depends on interest rates. Extra Space Storage reported that 82.5% of its debt was fixed rate. Net of variable rate receivables, effective fixed rate debt was 92.9%. The combined weighted average interest rate was 4.3%, and the weighted average maturity was 4.3 years. Those numbers help investors understand the balance sheet, but the broader point is that interest rates still affect REITs. They affect borrowing costs, they affect acquisition economics, they affect cap rates, they affect valuation, and they affect how investors compare REIT income with bonds and other alternatives. So even if the self-storage business is stable, the stock can still be sensitive to interest rates and valuation. Self-storage may be simple, but REIT math still depends on interest rates. And that is exactly why we analyze the full picture, not just the headline story. This is the kind of no-hype REIT analysis we focus on at Boring Money Wins. Not buying a stock just because the business sounds simple, not ignoring NOI, not ignoring core FFO, not ignoring expenses, interest rates, or valuation, and not pretending that every boring real estate business is automatically a good investment. If this kind of investing breakdown is useful, hit the like button and subscribe to the channel. It helps the channel grow and it tells YouTube to show more practical investing content to people who want clear analysis instead of hype. Now that we understand EXR's business, results, guidance, and key risks, let's compare it with the broader self-storage REIT space. When investors look at extra space storage, they often compare it with public storage and other self-storage REITs. EXR is a large operator with a major platform, third-party management, acquisitions, joint ventures, and operating expertise. Public Storage is another massive public self-storage peer with huge scale and a strong brand. Smaller self-storage REITs may offer more niche exposure, but they may also have less scale and more company-specific risk. The important point is that self-storage is not just about owning units. Scale matters, management matters, revenue management matters, balance sheet strength matters, dividend policy matters, same-store NOI matters, and valuation matters. In self-storage, scale matters, but valuation still decides returns. So after comparing the space, the next practical question is who EXR may actually fit. Extra space storage may appeal to investors who want exposure to self-storage real estate. It may also appeal to investors who like operational real estate with clear unit economics. EXR has scale. It has a large platform, it has high occupancy, and it has a management model that extends beyond only owned stores. It may fit long-term REIT investors who understand core FFO, NOI, occupancy, pricing power, and interest rate sensitivity. But investors should have moderate growth expectations. EXR is not a fast-growth technology stock. It is not a hype story. It is a quality real estate cash flow story that still has to execute. EXR may fit investors who want a high-quality self-storage REIT, not a fast-growth tech story. But that does not mean everyone should buy it. Some investors should be careful. Some investors should be careful with extra space storage. If you expect explosive growth, EXR may disappoint you. If you ignore interest rates, you may misunderstand REIT valuation. If you look only at dividend yield, you may miss the bigger picture. If you do not understand rental cycles, you may overestimate how smooth growth can be. If you buy without comparing valuation, you may overpay for a good business. And if you think self-storage is immune to the economy, that is too optimistic. Self-storage can be resilient, but resilient does not mean risk-free. Occupancy can change, pricing can soften, expenses can rise, interest rates can pressure valuations, and investors can still overpay. So before buying EXR, the question should not be only whether the business is good, the question should be whether the future cash flow justifies today's price. Now we can bring everything together. So is self-storage still a good investment in 2026? The balanced answer is yes, it can be, but not automatically. Extra space storage remains one of the most important self-storage REITs in the United States. It has scale. It has high occupancy, it has a strong operating platform, and it continues to generate solid core FFO. But the guidance also shows that growth is not explosive. Expenses matter, interest rates matter, pricing power matters, and valuation matters. Self-storage can still be a good investment in 2026, but only if investors pay a reasonable price for durable cash flow. The best real estate investment is not the one with the easiest story. It is the one where cash flow survives. That is the boring answer, and boring money usually wins because boring money usually survives.